three sorts of impacts. One, depending on the path dependency, are the market makers having to take off any delta from hedging the prior exposure that's now expiring? Two, what do the market makers have to do to hedge the new exposure? So that's all happening sort of in the Delta One space, right? What's happening, the impact to the S&P 500 predominantly. I'd be also interested in knowing what's happening to the volatility surface itself. I mean, are you seeing, because these are very predictable strikes now.
Yep.
Are you seeing significant kinks at this point in the surface?
Yeah, so the way that this works, right, is in some sense, people will say, I think generally correctly, that there isn't usually that much volatility market impact of the trade when it is quoted and executed for these kind of large predictable roll trades. And that's true. And that's sort of what the brokers pitch to why should you execute this way, right? They say, look, we have a lot of transparency into what the trade's going to be, and therefore we can be ready for it. And the term, used within banks is, accumulation of inventory and in anticipation of potential customer demand, right? And interpret that as you may. So of course, right, what happens is the volatility surface shifts in anticipation of this trade coming in as people accumulate the inventory that they need to be in a position to then execute this huge transaction, right? And there's nothing really nefarious about that. That's just a reality of, like, if somebody wants to execute this massive transaction in these kind of markets, somebody's going to have to be able to facilitate that and work into those positions over time. So yes, you do see the skew surface shifting and the maturity that they're going to be trading increasingly so as the strike ranges become increasingly clear.
So, go ahead, Rodrigo.
No, I was just so is this surface shifting a fairly predictable movement that market makers or alpha generating managers like you can very clearly snipe on a quarterly basis? Or is it always, you talked about how it all depends on what the path of the market was, what the positions are, but is there some sort of modeling that allows you to take advantage of that? Or is it so different every quarter that it's difficult to...
It is certainly the kind of thing that market makers and volatility arbitrageurs attempt to do, right? It's their attempt to be able to provide the liquidity to these kind of transactions that has to occur, right? It doesn't mean it's easy because you don't know, right? What they're going to do is they're going to trade a 95%, 80% put spread and sell the call that makes that structure premium neutral. And you don't know what strike that's going to be in advance, right? So you can't come in 2 weeks before and just do exactly the opposite of the trade that they're going to do and have it, right? What you can do is start to work into a range of exposure that's probabilistically reflective of what they're going to need to do and do that more and more and more the closer you get, and then, and so forth. And then what if the market moves a whole lot and all of a sudden you're way off center on the type of exposure that you have and so forth, right? So it's like everything else. It's a risk reward game.